Markets are rallying today with the S&P rising back above 6,900, supported by gains in major technology stocks. Our next guest says he's overweight equities for the next 12 months. Let's go to Darius Dale, founder and CEO of 42 Macro. Darius, thanks for joining us today.
Thanks for having me, Morel. It's wonderful to be here again. Thank you.
What's leading you to be overweight in equities for 2026?
Well, that's a great question. There's a lot of really good things going on. I would say to just start from a top-down perspective, there are only 6 key macro cycles that impact the momentum and dispersion of asset markets on a trending basis. It's growth, it's inflation, it's monetary policy, it's fiscal policy, it's liquidity and positioning. Right now, growth, inflation, and liquidity are currently tailwinds. Monetary policy and fiscal policy have a high probability of evolving into tailwinds, which ultimately means we're going to have 5 of 6 key macro cycles that are tailwinds for risk assets at some point this year. In our opinion, it's going to be hard to hold back the markets, even in the context of this historic crowded degree of bullish positioning that we continue to observe.
Okay, but you do think the move higher will be a white knuckle move. Why is that?
Yeah, well, again, we're starting the year at a historic degree of crowded bullish positioning. Historically, what that means is that, you tend to see a higher frequency of corrections. You tend to see a higher severity of corrections and crashes when you have that as a starting point. So ultimately, what needs to happen, because the positioning cycle is not a catalyst, we need to have negative trends develop in those other 5 key macro cycles. And what I'm telling you is that according to our models and according to our research, it's highly unlikely that over the next 12 months that we have negative trends develop in these cycles. What is highly likely is that we have a continuation of the positive trends that currently exist and in the advent of 2 more positive trends, particularly from the perspective of fiscal and monetary policy, and we can unpack any of that.
All right. You also see the market turning into a U-shape. Can you explain what that is and if you have a timeline for that?
Yeah, that's a great question. So not the market, but rather the economy, particularly the U.S. economy. When we authored the Paradigm C theme back in April, when we were telling investors to block out the noise from tariffs and start to get long assets, it was done. We made that call with the expectation that the U.S. economy would have a disinflationary negative aggregate demand shock. However, that negative aggregate demand shock would ultimately not materialize and morph into a recession, and ultimately we would have a pretty robust recovery on the other side of that. That robust recovery is driven by the confluence of monetary easing, the confluence of fiscal easing, the confluence of substantial deregulation, particularly in the financial sector, which touches every sector in the economy. And ultimately, we continue to have relatively positive demographic dynamics, particularly when you compare us to the rest of the developed world.
Okay, so let's talk a little bit more about the change of leadership that's coming at the Federal Reserve. What are you anticipating at this point for rate changes?
Yeah, well, so from a rate change perspective, it's highly likely that if we see any movement from here on the policy rate, it'll likely be well into the next Fed chair's tenure, which may in fact be delayed to the extent that this inquiry against Chair Powell continues to fester, and the Trump administration obviously gets some pushback in the Senate with regarding incremental confirmations. But ultimately, it's our view that the U.S. is in the precipice of a structural uptrend in productivity growth. And what that'll ultimately do is it'll shave about, roughly around, according to our models, 50 basis points off of trend inflation, which would help inflation to settle out nicely at a level that is more consistent with the Fed's arbitrary 2% target closer to the end of the year. We may see a transitory bump in inflation sometime around Q1, Q2 as a function of the fiscal stimulus we're anticipating. But the reality is that is likely to be a transitory dynamic that is offset by continued disinflation in housing and continued disinflation in wages.
Okay, so let's get to sectors that you like for 2026. What are you looking at?
Yeah, so we've been consistent since April that our top 4 sector picks are digital economy growth. You have to have some exposure to the AI names with regards to the companies that are generating the most cash that have the ability to sustain that cash flow or sustain their stock price appreciation with stocks and buybacks. So that's obviously tech and comm services. But more increasingly, we've been guiding investors to the broadening out trade. And so the other 2 sectors on the other side of that digital economy growth is real economy growth. We still like the financials. We still like the home builders here because ultimately we think there's a tremendous amount of policy support coming their way that'll ultimately allow the home builders to increase margins and ultimately allow the financials to increase loan growth. And those are two things that are likely to be highly supportive of the broader growth backdrop, which again supports that broadening out trade, not just domestically, but also internationally.
And on the flip side, the sectors you're not liking right now are healthcare and consumer staples. And I'm wondering if you can give me your ideas behind each.
Well, when you're in a high growth environment, you don't want slow growth companies, period. I mean, it's as simple as that. It doesn't have to get any more complicated than that. And so what we're looking for is to rotate away from the perceived safety or the defensiveness of those sectors and use that as a source of funds to allocate to sectors that'll benefit from an economic boom and a structural uptrend in productivity growth that is likely to be perpetuated by the diffusion of AI into the economy, as well as the low turnover labor market where employees are just getting better at their jobs because they're not changing jobs as frequently.
I'm just wondering for healthcare, can you marry healthcare and AI and see gains there? Because obviously AI will be deployed in healthcare settings more and more, which could allow them to first have fewer employees and then get people faster through the process or be able to give them more detailed information about their cases.
Yeah, that's likely to be an ongoing story. And that's just one of many, many stories across dozens of industries and hundreds of businesses in this country, not thousands of businesses in this country, where they're going to use AI, use automation, use robotics to increase their margins. I'm not saying this is a great outcome for society, because it probably won't be a great outcome for society. But what we're likely to see over the long term is a divergence between earnings and the market and the labor market. And so from the perspective of labor winning or losing that age-old struggle versus capital, that's actually bullish for stocks and bullish for risk assets. But again, maybe not so great for a society.
All right. Darius Dale, appreciate you joining us, sir. Thanks for your time.